Yeah, look, I think undercurrents had been there for some time period, and then I think you had some events that all of a sudden the yen currency unwind. All of a sudden, these undercurrents came to the surface, at least for a couple of days.
There was a view, I think, even before the violence of the selling, that it may not be a great idea to have such a huge concentration of assets in just 7 names, or actually it was 6. We'd taken Tesla out of the equation. I think the 6-odd stock stateside. You mentioned diversification has been a theme. No doubt that has been amplified by the events that have happened. What sort of diversification strategies are investors talking about now?
Yeah, what we've seen is, as you mentioned, probably concentration comparable to the TMT.com bubble into the Magnificent Seven, so the market cap weighted. What we've also seen, though, is investors looking to diversify in strategies rather than buying the market cap weighted S&P 500 with a concentration, buying equal weight. So that what it gives you a tilt toward smaller companies as well as a value and more defensive, and building through that. We've also seen not only in the cash equity market, but in derivatives. There's now a futures contract as well, E-mini futures contract on the equal weight. So now we're starting to see that diversification. And what typically at this stage we have seen in July, for example, after the U.S. inflation numbers came out, high outperformance in that month for small cap. You've also seen value and some defensive sectors, performing well. So that gives you the equal weight opportunity to really diversify away from that concentration.
Yeah, you think that concentration stateside, though, really, I think as it begins to bulk up, investors then say, well, this is getting too much, and then continued to plow in for some time then. And then finally now you've sort of seen, I don't want to call it a bubble, but a bursting somewhat of a little bit of that exuberance. Does that create the kind of fear that this sort of thing happens from time to time? And how do markets then sort of alleviate the strain it actually puts on other indices or on creating this sort of element? Or is it just a case of, well, it's market dynamics, it happens?
Well, it does. I mean, you do see markets get concentrated over periods of time.
Yeah.
In the 60s, you had the trons, the electronics. You had in the 70s energy sector concentration, and then when interest rates started coming down in the 80s and 90s, financials really benefited for long periods of time. But this level of concentration has been acute. But as we've seen, mean aversion is starting to take place, and particularly when you look at potential rate cycle changes, U.S., obviously the other direction in Japan, you're starting to see money in motion. But the mean reversion is really critical. So if you're a longer term investor, the diversification is your free lunch. And that ability to get factors more defensive or maybe interest rate sensitive. You mentioned real estate this morning. So you're starting to see those factors which, again, had really lagged. We had over the last 12 months, momentum had outperformed the S&P 500 as a factor by 30%. We saw equal weight had underperformed the S&P 500 by 9%. So mean reversion is taking place.
Oh, such an interesting one there. I wanted to jump, however, to the Dow Jones Industrial Average itself. At best, it feels like an imperfect barometer. It's concentrated on these 30 companies. It feels as though it's a little bit clunky in some ways as well. How do you set up that index, and how do you look at it as fit for purpose for future, considering the changes that happen in the market?
Well, I like the term you use, barometer.
Yeah.
So we think about things as barometers becoming benchmarks, and then benchmarks becoming investable indices and products like ETFs, mutual funds, things like that. The Dow was the original barometer.
Yeah.
I mean, you could argue in the late 19th century, maybe the U.S. was an emerging market back in those days, but you didn't have the government statistics. So how do you measure an economy? Well, the stock market provided numbers. Charles Dow, the founder of the Dow Jones, or the editor of the Dow Jones and Wall Street Journal at the time, came up with this metric and barometer of predominantly rail companies and later industrial companies. But that's where in the 50s, 67 years ago, the S&P 500 with market cap weighting became much more representative and but still the Dow is a critical barometer with historical precedence, a long period of time. But you see clearly the liquidity, $12 trillion either benchmark or in investable products on the S&P 500 today. It is the main barometer for the U.S. stock market. And globally, U.S. equities account for about 60% of S&P World Index.